Good morning. Hello and welcome to a fresh new edition of Bazaar Morning Call. I'm Prashant. With me, my colleagues Nigel and Breema joins us today. Good morning, guys.
Good morning.
Finally, it's a Friday and we head into the World Cup weekend. But there is more sports, Nigel, for you today, I believe, right?
Yeah, I'm going to be going for my daughter's sports day, so I'm quite excited about that. But the big event is going to be, I'm sure, Sunday night.
11 p.m.
8:30.
8:30.
8:30, okay.
It's a reasonable hour.
We can watch it, finally.
But it's not looking as great, although it's a Friday, it's not looking as great for markets, right? I mean, we got a real reaction yesterday out of the US markets, a big one at that, and that's basically the two indices in the US and, the 50 stock benchmark index out of the Euro. 3% cuts on the Nasdaq and the Euro Stoxx 50. This is some aggressive selling that we've seen. And I was saying this yesterday morning that the reaction, immediately on the day of the Fed was a whimper. I mean, nothing. It was actually a dovish reaction to a hawkish Fed. We've got more, right? I mean, so for example, you had the two other central bank meetings. Actually, you had 4 or 5, but the two big out of Europe were ECB and the Bank of England. ECB delivered a 50 basis point hike, but in the press conference, Christine Lagarde sounded very hawkish, clearly hawkish. So market expectations of what the ECB will do is also kind of moved up. The other thing is the dollar. And again, something I said yesterday, the one big notable feature of the Fed reaction was that the dollar was down on the day. I mean, it was just baffling, but we've seen a rally. And the dollar is now started to move back up again. That's the DXY. But if you look at the Bloomberg Dollar Index, that is almost back to the 200-day moving average, which was at about 1269.92. It had fallen below the November levels for the first time since 2021. So we are kind of inching back a little bit. Remember, all of this is happening, as we wrap up this year, as kind of participation thins out. But price action is price action, although you should keep that in mind as well. Thinly participated markets exaggerate price action on both sides. That said, as I said, price action is what we're seeing right now. So the dollar is moving higher, has moved higher last night. The Nifty and the Bank Nifty, just to come to our sort of levels here, closed practically at the lowest points of the day. I mean, a few points away from the low point on the Nifty and both the Bank Nifty. The first support for the Nifty comes in at the lower, there's a small channel from the high, the recent high, which is 18,887. If you join the tops from that point on, the support comes in at about 18,280. That's number one. The bigger support, of course, is the November lows. 18,133 is the lows in November, and I think that's something you need to watch out for eventually. The point is bears have been on the back foot, not just this week, this month, all year through, right? And the reason is simple. You see a big correction in the US, things are looking bad, and you go short, you come up the next morning, market opens lower, and just like that, there is an impulse to buy. The dip buying comes back, and people, looking at price action, I would say bears would be very, people who are short would be very, very scared to hold. What if this keeps going? And it's happened before. But having said that, I would still say, given the given how things are coming together, both in US, the dollar index move, and of course, the basic underlay is that the Fed has been extremely hawkish. Even if you do get a bit of a bounce, don't go all in, be cautious. You don't want to kind of blow up as we wrap this here. This is not the time for that. So that's, I think, my message, at least this morning, looking at the price action. There are stock-specific opportunities. There always are, and we'll highlight those as we go along. Morning, guys.
Hi, good morning. So just some more on the central bank action. While the rate hike was in line with what the market was anticipating, it was the commentary which was extremely cautious. The markets were hoping that we will have some signs of a pivot, but if you listen carefully to the commentary from across the central banks, there is no sign of a pivot just yet. ECB President Christine Lagarde stressed, if you compare with the Fed, we have more ground to cover, we have longer to go. We're not slowing down, we are in for the longer game. BOE committee reiterated that if the economy were to develop broadly in line with their November projections, further increases in bank rates might be required. So all the central banks have revised their inflation forecasts higher, and they are indicating that they're not done just yet with the rate hikes. And as the FOMC, the Fed officials said, we're going to see higher for longer. Also separately, we've been talking a lot about the Fed, ECB, Bank of England. These were the big influential central banks which hiked rates this week. But apart from that, there were a whole host of central banks which upped rates. So you had the Swiss National Bank, you had Denmark, Taiwan, Norway, Philippines, Mauritius. There are Gulf countries which are pegged to the Fed. So Gulf countries cumulatively have seen a 200 basis points rate hike as well. So effectively this week, nearly 600 basis points of rate hike have taken place across the world, and that is fairly seminal. Talking about the flows that the Indian market saw yesterday, holiday season upcoming, so the flows have thinned out, especially on the gross volume side. Yesterday, DIs bought 260 crore, the FIs sold 711 crore. For the FIs, it's a net sell figure in cash after 2 days of buying. For the DIIs, it's the 7th consecutive day of a buy figure. It's a good thing because in the month of November, the DIIs had sold more than 6,000 crore in the cash market. The fact that it's turned around gives you some hope that if the FIs were to continue selling, the DIIs are there to go ahead and buy high.
Well, Rima, it appears Santa's arrival has been pushed back because of these hawkish central bankers, right?
Yeah.
But, I'm feeling a little bit cautious, actually. The Nifty yesterday, it didn't take support at any level. In fact, the final tick was virtually at the low point of the day. Maybe some part of it was expiry related, but I think it'll be prudent to be a little bit cautious in the near term, wait for global equity markets to stabilize, and then, in fact, take a bigger bet. But don't go all in. That's the advice, going by the data points. And the FIs, well, their short positioning has been increasing. Will they go net short on the index now? That will not be such a bad thing. That could be the trigger that, in fact, the bulls will want out there. Yesterday as well, they added close to on 10,000 short contracts and they unwound some long contracts. And just take a look at their positioning. From the start of the series, the long positioning has come down and the short positioning now is at around 46%. I recall at the start of the series, we were talking about the FIs, they being net long. That's the long positions on the index minus the short positions being nearly around a lakh odd. Guess what? That's come down to around 12,000 contracts odd. So in the way those long positioning has come down, the net longs, which again, I'll say it's not such a bad thing. Otherwise, you were in la la land with that 88,000 long contracts, net long contracts. Options data. What broke the back yesterday was the unwinding we saw at the 18,400 and 18,500 put. Close to around 7 to 8 lakh shares got unwound at that strike. And on the upside, there is resistance level because the 18,600 call, 18,700 call, both of them added a fair bit of open interest. Close to around 90 lakh shares added between those two, telling you that at higher levels, we like to see some bit of resistance. So what are the levels you're looking at then? Well, the 20 DMA, a fresh breakout will come only once you cross the 20 DMA on the upside. So that's an important level to track for today's session. While, if we see a bit of a downtick, maybe we go ahead and retest levels of 18,100 or thereabouts. For me, the joke on the pack, though, is the Nifty Bank. It's still trading above the 20 DMA. That's a bit of a support zone. So just keep an eye out on that. If the Nifty Bank can hold on to this level, then maybe, in fact, it'll give the bulls some hope. But otherwise, a little bit cautious in the near term. Keep an eye out on the Nifty Bank support levels. Fresh breakout on the Nifty only once we get past that 20 DMA odd. For starters, SGX Nifty suggesting a bit of a downtick.
Okay, so it looks like the downtick will get extended. Yesterday, the key indices were down 1.5% on the Nifty and the Sensex. And this morning, the SGX Nifty is currently down 60 odd points. On the equities, Gautam Dugar of Motilal Oswal Financial Services expects the markets to remain in a range with a positive bias. He says global central bank action and commentary coupled with commodity price movements will act as near-term drivers. He says they have a positive bias towards financials and consumption. Their preferred stocks are ICICI Bank, SBI, Bank of Baroda, ITC, Titan, GCPL and Jubilant Food.
Well, let's get you some money market views as well. Bhaskar Panda of HDFC Bank says a barrage of rate hikes followed by hawkish commentary from major central banks, which includes the US Fed, European Central Bank and Bank of England to fight inflation has upended the recent bullishness. He says US retail sales figures are showing slowdown, yet labor market remains tight in the US. The dollar index rose overnight while oil was marginally higher. Bhaskar adds the recent rupee depreciation has captured most of this already as the currency hovers just shy of 83 to the dollar mark. He doesn't expect that to be breached, and hence the dollar INR pair may trade in a range of between 82.6 to 82.8 to the dollar.
On the bonds, Bhaskar Panda says the effects of coordinated central bank hikes will provide a base even for Indian yields despite lower inflation reading. He expects the 10-year benchmark yield to broadly move between 7.2 to 7.3%.
Well, we have a lot of stock-specific action which we're tracking for you this Friday morning in our special Top 10 segment. We're looking at ONGC, Oil India, Deepak Fertilizers, Reliance Industries, Hindustan Foods, Wipro, Tata Motors and Delivery. There's stocks on the back of positive news flow. However, we have GMM Pfaudler as well as Dr. Reddy's that could be reacting to negative news flow.
This optimist in me hoped that they would give a little bit more weight to the fact that certainly looks like the CPI inflation rate peaked in June and continued to moderate right through November. That's a big deal, in my opinion. And I think it's going to continue to moderate. But I think because the Fed was so late to the game in raising interest rates, now they may be a little bit overdoing it. But look, I think the economy is going to prove to be remarkably resilient. I think it can handle 5.25% on the Fed funds rate.
All right, so that's basically some opinion. But we've got Matt Orton live with us now. He's Chief Market Strategist at Raymond James Investment Management. Matt, it's always a pleasure having you with us here on CNBC-TV18. You know, you've been bullish on India, but it seems like in global markets, we are starting a new chapter even as we wind down this year. Is that so? And this is a risk-off chapter in that sense. From the looks of it, would you agree?
Hey, good morning, Prashant. Great to see you again. And I think we're in a little bit of a blip right now. I think the market is having a collision of two narratives at this point. We've been so one-dimensional throughout the entire year of 2022, really being focused on inflation. Everything that has happened has been related to inflation in one way, shape, or form. And now we're looking at the economic reality and what does that look like? How is it going to materialize going forward, both in the US and around the rest of the world? And I think, like your identity just before me, I think the US economy is going to prove to be more resilient than a lot of people give it credit for. My expectation, we've talked about this in the past, is to see a 5.25%, terminal Fed rate, leaving it higher for longer. But because of the tight labor market that we have in the US and the fact that people are still making more money, are still continuing to spend, even though it might be slowing down, that can sustain the overall economy to not see a hard landing. Around the rest of the world, it's going to be more idiosyncratic. It's really going to be country specific. I don't like Europe right now. I think inflation being in double digits is going to take a lot in order to get under control. And there's still a lagged impact of having China closed for so long. But when you look at Latin America, that's been in an area that I've liked for a while. I still selectively like some countries like Mexico, Colombia, Peru. I'm a little bit less bullish on Brazil at this point. And then moving into Asia, I think countries that are tangentially related to China, so call it Vietnam, South Korea, the Philippines, Indonesia, those look interesting along a China reopening story, increased trade. And I do still like India. On a forward multiple, you're trading just around on the Nifty where you were pre-COVID. I think you're going to see margins expand. You're starting to see that play out. And there's some areas of opportunity that I still like within the country. And even though it was such a big outperformer over the past year, I think that can sustain. But my main message to clients, I've been traveling for the past couple of weeks, sharing outlook with a lot of clients around the country. And the main message, I think this applies everywhere around the world, is we still need to remain defensive. You don't want to chase the market higher. And wherever your allocation is, you want to be leaning into higher quality companies that are throwing off free cash flow. And I think that should guide any investment decisions, at least into the middle of next year.
Matt, morning, and thanks so much for joining in. So there is no risk to inflows into India because of China reopening. That's my first question. And the second one is, you spoke about the portfolio needs to be tilted towards defensive stocks, high quality, cash generating companies. Now, in India, the cash generating companies are your technology names, but they have the exposure to the global markets, including Europe, where the outlook is deteriorating. So in that sense, what is the portfolio approach in India?
Yeah, hey, Raymond, it's a great question. And I think India, you've seen India lag over the past month or so as the China reopening story has played out. And you've seen China rally incredibly robustly, as well as Taiwan and some of the other countries that are related to China. But I think that's going to be short term because there's still a lot of uncertainty around China, not just the sustainability of completely reversing the zero COVID policy. But what does government regulation look like going forward? I think there's going to be reticence on the minds of a lot of investors to really being aggressive and moving into China. So I think India can benefit from that once you get some of those initial trades out of the way. And information technology is an area within India that I've liked really for the past quarter or so. And we've talked about it a couple of times in the past. And one of the reasons I like it is because it is exposed to the rest of the world. A lot of the consultancy companies that take and offshore some of the resources that European and U.S. banks and larger corporations need assistance with, that's an area that's going to continue as margins come under pressure and companies have to find ways to be more efficient. And I think you're seeing Indian technology, especially IT services, benefit from that trend. And I would expect that to continue going forward as you see margins come under a little bit more pressure around both the US and Europe.
Hi, Matt. Good morning. Nigel on this side. Matt, the other question I wanted to ask you is, do you believe the Fed will go the distance and walk the talk? They sounded pretty hawkish, but some part, and some opinion that's coming in believes that maybe it's a bit of a bluff and they'll be forced, to go a little easy towards the end of 2023. And that rate cutting that they're talking about in 2024, that may be preponed a little bit. Your thoughts?
Nigel, I was really surprised by the reaction on Wednesday. I think the reaction we had today was the reaction we should have had on Wednesday, because the fact of the matter is, and the market has gotten this wrong consistently, really throughout the back half of 2022, every time the Fed and Powell has been emphatic in saying rates are going to be higher and they're going to stay there for longer. Somehow there's some dovish interpretation of the message that the Fed gives, and then they come out again and say we're going to be higher, we're going to be there for longer. And the dot plots once again confirm that. The median dot for 2023 is at 5.1%, and it doesn't have any rate cuts moving in the year for 2023. The market heading into the Fed was pricing 50 basis points of cuts in 23 and 200 basis points of cuts in 2024. And to get to that point, you've got to have a very hard landing scenario, and I just don't see it playing out. There's definitely cracks that are forming in the US economy, and that's to be expected as you're unwinding a zero interest rate policy and as the economy is in fact slowing down. But just because it's slowing down doesn't necessarily mean you need to go into recession, and it doesn't mean you need to have a severe drawdown in earnings. And I think what the market has missed is that even with Fed funds at 5.25%, or wherever the terminal rate ends up sitting, a lot of the economy can certainly withstand that. And when we do see recession, my expectation is it's going to be a real recession. You might see a slowdown in real growth, but you're still going to see nominal growth. And it's not going to impact every sector at the same time. And the same thing is going to go for earnings. You're not going to see an earnings drawdown at the same time across the whole economy. And I think that's why you're not going to get the scenario of one big 15, 20% EPS decline, and that can sustain the market or help it move higher into next year.
Matt, thank you very much for joining in. Great conversation. Look forward to chatting with you more often. And in case we don't speak before the end of this year, a happy new year. Season's greetings to you.
Thank you. Thanks very much.
Thank you. Time for a quick break. Our list of top 10 stocks is lined up next. Welcome back. The Asian markets are following the sell-off that we had in Wall Street overnight. The big cuts are in the Taiwanese markets and the Japanese markets, which are down close to about 1.5%. Hang Seng is recovering, so Hang Seng is now up close to about 0.7%, but the rest of the Asian markets is under pressure, and the SGX Nifty is suggesting a lower start, currently down 50-odd points. Adding on to the 250-point knock that we had in yesterday's trading session. But what about individual stocks? Our entire research team is standing by with CNBC-TV18's list of top 10 stocks for the day. And first up, let's go across to Sonal, who's going to tell us about the big windfall tax cut. Sonal?
Good morning, Rima. Well, yes, another one that has been announced now, and this time again, it's massive cut that we are seeing. On crude, it has been reduced to 1,700 rupees per ton versus 4,900 rupees per ton. That was done just 15 days back. Windfall tax on diesel has been cut to 5 rupees per litre versus 8 rupees per litre. Even on ATF, it has been cut to 1.5 rupees per litre versus 5 rupees per litre earlier. On petrol, it continues to remain nil. Now, there were indications that yes, there will be another cut because of the way crude prices had moved. Jeffries, in a note last week, had written that they see the possibilities of export duties on both diesel and ATF to be withdrawn in the near future. Yesterday, we spoke to IIFL and they said if oil prices continue to remain at these levels, there is a chance that windfall taxes will be lowered substantially. Just to give you some perspective, from the time it has been levied, that is 1st of July, there has been a massive cut. On crude, from 23,250 rupees per ton, it has been reduced to around 1,700 now. On diesel, petrol and ATF, there has been a massive cut. And the expectation is if crude prices continue to be lower, there will be further fall in windfall tax as well.
Okay, all right. So now thanks a lot for that. Well, Abhishek joins us to tell us about GMM Pfaudler. There's going to be a large trade, Abhishek.
Well, Nigel, as you mentioned, there will be a huge block coming in GM Pfaudler. So, Pfaudler to sell around 29.88% equity in the company. So, in absolute volume-wise, it's about 1.34 crore shares. The offer size works out to be at 2283 crores or about $277 million. So, Axis Capital is the sole broker. Now, the floor price, that's an interesting part. It's been set at 1700 per share, which is a steep discount of over 11.5% to yesterday's closing price. So the promoter holding will decline to 26.2% from earlier more than 56%. And if you take a look at the shareholding history of Pfaudler, it's declined from June 20 level of about 50.44% to now about 31.88% as of September 22. And post this deal, it will be around 2%. Back to you.
Okay, all right. Thanks very much. And that's an interesting name, which we will get you more on with guests later on. But Deepak Fertilizer is the other one, which is also in focus. Sonal, back to you.
Yes, Deepak Fertilizers, they have actually announced a demerger of their mining and fertilizer business. So that definitely is a big one. There are two transactions happening here. There's a scheme of arrangement between STL and DMSPL, two subsidiaries of the company. And there is so from there, there'll be demerger of the TAN business, that is the mining business, from STL to DMSPL. So these are the two subsidiaries from which one, the mining business will go from one to the other. The second one is amalgamation of Mahadan Farm Technologies Private Limited, which is a wholly owned subsidiary of STL with STL. So that is also important, but the bigger one is demerger of the mining business. And now mining business had revenues of almost 2,500 crore rupees in FY22. That is 44% of the total revenues of the company. The demerger ratio is 1:1, and the company says that the rationale here is simplification of their corporate structure, economies of scale, and it is in line with their focus on specialty versus commodity business earlier. So that is something they have been highlighting to us as well. And they are planning to unlock growth potential in each of the businesses so that each of them can work with the macros that there are in the businesses. So that's the rationale. The stock will be in focus today.
Okay, thank you very much for that. And now let's go across to Manglam. He's going to tell us about some more stocks in the news. Manglam?
Well, I have three stocks on my list today. We start with Reliance because Reliance has finally announced the launch of its FMCG brand. Remember, in the annual general meeting, they had announced their foray into the FMCG world, and now they've announced the name of the brand. It's called Independence, and the range will initially offer edible oils, grains, packaged food, and other daily need products, and this will only widen further. The company says that this will be high-quality, affordable products. This is in line with what the company had announced. Analysts see this as a positive step, but does it impact other companies? Well, not yet for the top-tier companies, but definitely important to watch impact on challenger brands like Patanjali Foods, Adani Wilmar, and other players as well. So that's about Reliance. Hindustan Foods is the other one that I'm tracking. It's acquired Reckitt Benckiser's Healthcare India's Khasra manufacturing facility for about 160 odd crores, and their core business is basically to buy non-core businesses of other large FMCG companies, and that's how the company grows. So this is again a positive step. And finally, Wipro wins an order as Mazda Europe has selected the company for application transformation in a 5-year multi-million-dollar deal. So that's a positive.
All right, Manglam, thanks so much for that. Well, Vivek joins us to run us through some more stocks in the news. Morning, Vivek.
Well, good morning. A few stocks on the radar. This is on the back of likely passive fund flows. So both, the sensex as well as the FTSE will be seeing some adjustments. So first, let's have a look at, the FTSE adjustments. So delivery is going to be one of the stocks that will be added into the FTSE all-cap index, and this particular adjustment will be done in today's trading session. Analysts estimate a likely inflow of close to $8 million into the stock on the back of this particular entry. Also keep an eye out for, Dr. Reddy as well as Tata Motors. Effective Monday, the Sensex will have a new look. So Dr. Reddy's will be removed from the Sensex, a likely outflow of close to $100 million, while Tata Motors will enter the Sensex at the expense of Dr. Reddy's, and expect inflows of close to $135 million. These inflows and outflows will happen in today's trading session.
Thank you very much, Vivek, for that. Here's a quick recap of the top stocks we're tracking this Friday morning. Stocks with positive news flow are ONGC, Oil India, Deepak Fertilizer, Reliance, Hindustan Foods, Wipro, Tata Motors and Delivery. Stocks with negative news flow are GMM Pfaudler and Dr. Reddy's Laboratories. Let's get chatting about commodities then. Manisha Gupta joins in for a roundup of all the action from the commodity market overnight. Manisha?
Thank you so much for that. I'll start with the crude oil prices, where after 8% of gains in last 3 trading sessions, overnight has been a 2% of a decline. This is because there is some strength in US dollar and expectation that the rate hikes would continue from the central banks into 2023 as well. And then the Chinese November factory output and retail sale numbers were on the weaker side. And markets also are looking at some supply disruption premium off, as the Keystone pipeline is resuming partial operations right now. When you look at the Goldman Sachs report, that continues to be very bullish on the crude oil prices. They're touting the prices to be $110 a barrel as an average in the next year. So those are the factors which are supporting the markets at the lower levels here. In the metal space as well, it's yet another day when we are looking at profit takings continuing. So whether it's copper, aluminum, nickel, all of these metals have opened on a lower side, but good gains continue for the ferrous metals. So steel and iron ore are doing well, as the markets believe that weak Chinese data will lead to further stimulus coming in from that country.
Okay, all right. Thanks a lot for that, Manisha. Well, for the time being, though, we'll slip into a short break. You come back. Devin Chauksey of KR Chauksey, he'll be joining in to discuss some fundamental stock analysis. And later on, we'll connect with the management of Healthcare Global Enterprises to discuss how business is shaping up. Welcome back. Hope you're having a good morning. Well, to discuss a whole host of stocks, well, we're joined by Mr. Devin Chauksey of KR Chauksey. Hi, Devin. Good morning. Well, let's talk about some of the stocks that will be in focus, because that windfall tax is gradually getting pulled back, particularly on diesel as well as on ATF. How do you approach these stocks, namely Oil India, ONGC and Reliance Industries?
Nigel, good morning. Well, with the correction in the crude oil prices, and I think the price is staying at a lower level, the amount of money, I think, which would otherwise be collected by way of windfall tax, I think, is probably now going. So this is a non-tax, I think, as far as the, I think, companies are concerned. So from that perspective, I think the superlative profit and the superlative tax both have gone, as I see it. Going forward, I believe that I think if the crude oil prices stays in the stability region of around $80 to $90 per barrel, then possibly I think most of these companies would have relatively better times going forward. As of now, as it stands, I think probably in the refining segment, the cracks are on a positive side. And that is where probably I think this quarter should result into relatively better performance for most of the companies, including the lands industries.
Devin, hi. Good morning. You know, the IT services sector sold off big time, Devin, yesterday. Once again, I mean, it had a bit of a reprieve in the earlier part of the week, but it all went away. And today, we, I think, get the Accenture numbers, which we will talk more about a little later. And that perhaps is a cue. What's your sense, IT services from here? Will it continue to get whipsawed one way or the other, maybe small bounces, but bigger drops?
So good morning, Prashant. As I understand, I think the market action yesterday in some of the large cap counters, including in IT, I think have been the outcome of some of the global portfolios shading their weight into from the portfolios and India exposure. In my viewpoint, I think nothing but the technical correction which is happening. Some of the larger companies where I think they are shading their weights. I think it includes IT company, includes Reliance, includes some of the banking counters as well, where I think a part of profit booking position or some amount of weight reduction has happened from their portfolio. I don't see anything fundamentally wrong with many of the IT companies. On the contrary, I see a good reason for this some of the large cap IT companies to bounce back at some point of time. In the corrective downside, I think we are likely to see the buying taking place into this counter, including companies like Wipro, which has announced, I think, a deal yesterday. I think they are the ones, I think, who are basically showing some large contracts, I think, getting signed up for multiple years, giving them a visibility of 5 to 7 years on each contract of a larger size. So from that point of view, I think that the IT companies deserves to be there in the portfolio. Any corrective fall or downside due to any technical nature in the market, I think would be a welcome opportunity for long-term investments as far as I think the quality names are concerned.
Okay, so IT names are looking attractive to you right now. Devin, what about GMM Pfaudler? The big news today is Pfaudler Inc., which is a promoter of GMM Pfaudler, is looking to sell close to 30% stake in a block deal today at a price of 1,700 rupees per share, which will give the promoter close to 2,300 crore rupees. This is big, right? A promoter selling close to about 30% stake. Your thoughts on what it means for shareholders?
So, Rima, I haven't examined this particular transaction so far, so would refrain from putting any comments, maybe at some other point of time.
Okay. What about Reliance Industries? They've done that launch, the Independence launch, the FMCG staples kind of business. Well, right now, analysts are saying that, it may not have an impact on the other listed entities, but we know Reliance Industries tends to be fairly disruptive in whichever segments they enter in. How would you read this development and the impact on other listed players? Would you tread with caution?
Well, I think one important point, I think, which you are basically observing here, Reliance has created on-ground presence of their stores. And now they have got the tie-up with Kirana stores. So obviously, I think they have created the market outlets, I think, for themselves to begin with. Now creating a brand and putting into the shelf, I think, is basically the sensible thing to do. Because with your own brand, you are commanding better margins compared to, I think, the brands that you are selling from other FMCG players, and including among the other food companies. So from a perspective of, I think, getting relatively better margin, and that too, I think, having your own outlets to sell, this is a win-win combination as far as, I think, companies like Reliance in the retail segment goes. So in my viewpoint, I think it should be seen as a winning strategy. You may call it a disruptive strategy. I would call it as a, I think, well-planned and thought-out strategy, wherein on one side you create, I think, the outlets, and on the other side, you are basically promoting your own products on your own brands, which is what I think the company has been doing. I don't know immediately whether one can say that it will have impact on other FMCG companies, but I would think that I think the move remains distinctly positive for Reliance Retail per se, as far as I think their business is concerned.
All right, Deven, just request you to hold on. We're just going to be going and having a chat with the management. We're going to come back to you. Healthcare Global, that's the stock in focus. Well, we got highlights from a meet they had with ICICI Securities. The company is looking at ramping up their margins from year on and also improving their ROCE. To discuss the outlook, we're joined by Mr. B.S. Ajay Kumar, the chairman and CEO at the company. Hi, sir. Morning. Thanks so much for joining in. Well, let's focus on both those 2 points itself. Margins, I believe, you have a couple of reasons that you're going to be focusing on, a couple of factors which will help improve your margins. So what is the targeted margins you're looking at? And I believe you want to take your ROCE as well up to around 18 to 20%. Give us a time frame for that.
Yeah, thanks for having me. And as far as the margins are concerned, we have been focusing on the margins quite a few times. Obviously, the COVID interrupted it, but post-COVID period, we have recovered very well. Our margin now in the range of about 18 to 19%. Mature centers are actually in the mid-20s, and we expect even the centers which are new to ramp up to that level. So we are looking at margins in the region of low 20s as we move forward to the 23-24. Our goal is in the low 20s. And one of the reasons we are achieving this is brought in a lot of operational efficiency in the system. Apart from the centers which are ramping up to mature centers, obviously once they ramp up to mature centers, we expect the margins to improve. And this has been one of our focus in the last 12 months as we enter the period of consolidation. As far as the ROC is concerned, once again in our centers which are mature, we are seeing ROC in the region of about 20-22%. Our center of excellence has a 25% ROC. Obviously, the new centers are ramping up, particularly centers like Mumbai, Calcutta. Once they ramp up, we expect the ROC to reach the level of mid-teens and going forward to around 20%. This is what our expectation is as we move forward to the new year.
So low 20s margins by FY24, FY25. That's the guidance, sir, that you're sharing with us. Can you tell us what are the kind of margins that you make on your international patients, medical tourism, because that's picking up as well. What is it currently contributing? The last time we spoke, you said it was about 5%. Has that gone up even further? And the kind of margins, sir, that you make on this?
The international contribution is, as you know, it is fragmented, only big cities.
Yes.
Our bank center is close to 18% is our revenue is from international, and it is ramping up very well. Mumbai, Calcutta are also participating apart from Ahmedabad. And overall margin is still around 5 to 6%. I don't expect that to increase significantly in the coming year. But the margins in that area in the international is not a whole lot different from what we see in the margin domestic. It's about 10 to 12% higher than the domestic.
All right, margins 10 to 12% high. That's a sizable number, sir. I mean, if that ramps up, then it could help the overall margins as well.
Yes.
And you're saying you're expecting the contribution to stick around 5 to 6%.
Yes.
Okay, all right. You're also on the prowl, I believe. You're looking at standalone oncology units, and you're looking at trying to, do some inorganic growth. Give us a couple of details. First up, what is the size? What is the size you're looking at? And second, what is the timeline? Do you think you'll close it out in this year, that's FY23? Or are discussions that are currently underway suggesting that actually it'll get pushed forth to FY24?
Yeah, as far as we are concerned, one thing I want to take a step back and say, cash flow is very important. We are very cash flow positive. We are generating somewhere around 15 to 20 crores positive cash flow every month. Obviously, and available debt we have puts us in a strong position to do some of the growth strategies for us. The growth is going to happen two ways. One is, of course, M&A. We are looking in discussions. We have already announced we're in discussion for our discussion with our Milan and Ovum, where it is in the final stages of closure. Apart from that, we have selected certain areas for merger acquisition in different states. Once, of course, that comes to fruitful, we'll, of course, announce it. And the third area we're looking at growth is really investment in technology itself and existing centers. We see a significant growth happening in the technology itself, like robotic technology, AI-related, genomics, circulating tumor cells. Investing in the present centers itself will give us a significant growth as we move forward, because there is a demand for high-end technology, high-end service, particularly in big cities. And this is where we see the third vertical of growth.
Mr. Ajay Kumar, we'll leave it to that. Thank you very much for joining in, and season's greetings to you and everyone at Healthcare Global.
Thank you.
Thank you. We'll slip into a very short break. On the other side, we'll be joined by Mitesh Thakkar and Shrikant Chauhan, and we'll get in some technical trades to power your Friday morning.
Okay, welcome back. We got about a 50-odd point cut on the Nifty. The SGX Nifty is indicative of that, 18,405. One thing which perhaps may come to the rescue for markets, perhaps is Reliance, right? I mean, if there is one stock which can punch far above its weight, or actually even punch its weight, that'll be enough for the market. And I'm referring to the news flow, which is the windfall tax cut. So maybe we get some help. And you throw in an ONGC there as well. and then you got a bit of a combination, right? So we'll see. But if you start with a 50, 55 odd point cut, I mean, I think that'll be great news. What after, I think, is the question. And there, as we've been saying, perhaps makes sense to be a little cautious at this stage and not jump in at the first sign of that dip. Mitesh is with us, and Srikanth is with us as well with their technical setups. Gentlemen, good morning. Great to have both of you here. Mitesh, we pretty much closed at the low point, and we've got deep red from overnight markets. What's your sense in terms of markets today, and what trades would you want viewers to take?
Morning, Prashant. Yesterday, when we were declining and we started trading below 18,600, we were then looking at a retest of 18,450, and then possibly in the worst case scenario, short-term targets around 18,300 could be tested. Yesterday, we closed below 18,450, so I think 18,300 should come into play. And my idea would be to not immediately buy into a 50-point cut, but in case we get closer to 18,300, then attempt along with a 40, 50-point kind of a stop loss. I think there should be some strong bounce back from those levels. Having said that, I think, what has turned slightly negative is that the daily indicators have started dipping and started turning negative. So while I do expect a bounce back from 18,300, I would not want to carry them as a positional trade, but in a day or two with that bounce back playing in, if that happens, then I think we'll want to take profit. So the overall bias has moved out from long positions or buy on declines to possibly trade and see where the consolidation finds its boundaries, and then, figure out which direction you want to finally get into.
Okay, all right, got that, Mitesh. Srikanth, let's come across to you. What's your call on both the two indices, Nifty and Nifty Bank?
Good morning, Nigel. Good morning, everyone. I think, the market has clearly formed lower top formation on Tuesday, and after that, we saw the market was finding resistance at every level. When looking at the entire pattern, I think very clearly Nifty is entering into corrective phase, and it is going to last for next few days or few weeks. So the strategy should be to look for reducing or creating short position on every rise. As yesterday we saw a huge amount of sell-off in our markets as well as in US markets. I think 18,300 is going to act as very good support on intraday basis. But broadly, we are expecting markets are heading towards the levels of 18,100 or maybe 18,000. So if there is any bounce back, then close to 18,450, 500, we should be seller in the market. And for the bank Nifty, I think 42,800, 42,750 is going to act as support. So till then, we need to be stay back from taking any long position.
Okay, so the bias is on the way down. Let's talk about individual names and what trades one can pick up for today. Mitesh, what do you recommend?
Good morning, Rima. I have a mix of buys and sells. So on the sell side is Bank of Baroda. After a long time, a PSU bank on the selling side, because I think now the sector looks like giving kind of a pullback and some kind of correction to their moving averages. So BOB in the short term could decline to about 176, sell here with a stop at 187. Bata is a sell with a stop at 1661 for targets of 1610. And on the buy side is Piramal Enterprises, conditional buy. I would want to see it get past 920. That's a good breakout level. So buy above that with a stop at 904 for a first target of 960. And MGL on a mild decline is a buy with a stop below 880 for targets of 915.
Srikanth, your recommendations?
Yeah, I think all these IT and commodity stocks should remain under pressure. And in that, TCS looks weak. Currently, it is around 3,300 levels. From here, the stock can slide to the levels of 3,150 or maybe 3,100. So it's a short sale at current levels with a stop loss at 3,350 on the higher side. And if we see the quick drop in the market, then close to 135, 134 level, we should look for adding some bank stocks because the momentum is still there. We can expect some rebound if there is a rebound in the market. So Federal Bank looks good around 135, 134 levels. With a stop loss at 130, again, we can expect 142, 145 on the higher side.
Okay, all right. Thanks a lot, Srikanth, as well as Mitesh, for joining in fact, giving us all of those details. Well, there is some good news actually that's coming in because India's trade deficit, it's come in at 6-month lows of around $24 billion. That's thanks to recovery in exports. The overall trade deficit counting goods and services has fallen to around $11 billion, which is much lower than a year ago as well as a month ago. Lata joins in to run us through all of that analysis. Lata.
Yes, actually a good trade deficit number after a long gap. And what is good is that there is a bit of a recovery in exports. The November exports has come in at almost 32 billion, 31.99 to be precise. Now, in October, this was 29.78. So that's a decent over $2 billion recovery. And it was $30 billion year ago. So both in comparison to both year ago and month ago, we've done somewhat better in exports. But this export figure that I'm showing you, 31.99, is the lowest since last November. That means for the last 12 months, we've been doing better at exports. So this is not a runaway recovery, but somewhat better than the October number. Imports at 55.8 billion is also a little lower than the October figure of 56.69. So mild improvement over there, probably because of slightly lower crude prices. So the overall trade deficit has therefore fallen to 23.81. It was as high as almost 27 billion, as you can see, in October. So that, again, is a somewhat decent recovery. The goods deficit is, like I told you, the lowest since May, and that's a relief. If you add goods and services, then again, the exports are, at 52 billion, much lower than year ago, but a month ago. So if you take exports, goods and services, it doesn't look very impressive. In fact, what is impressive is the fall in the November services imports. If you compare goods and services together, then there is a steep fall. We have come down to 65 billion from 73 billion in October. Now, I don't know what are the components of services imports, but clearly the magic lies over there. So to put everything together, what has gone good for us in November? Exports have done somewhat better, goods exports. The ministry has not given much details, which is a little surprising. They normally give you a long list export-wise. All they tell us is, okay, there is a marginal recovery in exports, but there is a huge fall in services imports. If we continue at this track, 11 billion a month, counting services and goods, then we are kind of out of the woods. But the point is, will we maintain? Look at the number of central banks who have raised interest rates. Look at the extent of recession that we will see in destination countries. So will we be able to maintain this track? Remains an open question.
All right, Lata, thank you very much. That's a comprehensive picture. And we'll keep tracking this one. It's extremely important from a macro standpoint. Now, Chandan Taparia is derivative and technical analyst at Motilal Oswal Financial Services. He's joining us to take some questions on how the F&O setups are looking. Chandan, hi, good morning. How are things looking? Is it looking a bit one-way-ish, or it's still very, very mixed? What's your sense?
Good morning, Prashant. We have seen a decline from higher levels on the last trading session. Nifty has corrected by more than 250 points and gone to the key retracement level of 18,380 marks. Now, looking at the global market, mixed cues are clearly visible. However, the Bank Nifty, which was strongest in last couple of weeks, has taken some pause in the positive momentum. But that is the part of the profit booking, and we believe that somehow support will work at lower level. So first, talking about Nifty, we believe that on downside, 18,200 is going to be the key support. So yesterday it has broken the key support of 18,442 and 18,380. So because of that, it can go to 18,200, but near to that level, it can form the base to again see the range bound move towards 18,200 to 18,700. So I think if further declines happen, then range bound bias again can be played in the Nifty index. And one need to understand that volatility index slightly moved up, but still that is below 14 level. So that is why we are having mixed view. But overall, major bias could remain intact to positive, and we'll wait for stability over next 1-2 days to again initiate the selective stock specific bet in the market. Looking at Bank Nifty index, it has corrected from higher level, but we have major support near to 43,000. So 43,000 could act as a support to again drive the move to us 43,750 to 44,000. So we are one step back, looking for some consolidation and mixed view. Then we'll again look for the next leg of rally. Now, looking at stock wise action in this market scenario, we'll go with the counter, which are comparatively having the relative strength and holding well even after the market correction from higher levels. So first that is buy on Britannia. Most of the FMCG counter are showing some sort of range bound bias or declines are being bought. So Britannia is one of the strongest setup, which has not fallen when market is correcting, holding well, trading near to lifetime high. A strong consolidation breakout is visible with shift of higher base. So recommending to buy Britannia for 3 to 5% uptick. One can buy with a stop loss of 43.80, and we are having the upside move to us 46.20 in Britannia. That is the lifetime high led by short covering activity as well. Second trading area, that is buy on MGL. We have seen good buying interest in gas distribution company, including MGL, IGL, and MGL has been respecting to its rising trend line, respected to its 50-day exponential moving average. Supporters buying, put writing, and long built-up is also visible, which can drive some uptick from current level. So one can buy with a stop loss of 885, and here we have a target towards 940 level. Last idea that we are recommending on the sell side, we have negative on most of the hospital or related counter or medicine pharma related counter. So whether you talk about Oro Pharma, Lalpet Lab, Metropolis, Loras Lab, all these stocks are showing weakness. So Oro Pharma has given a breakdown, trading at multiple weeks low. Shorts built up are visible. Negative crossover is also seen with call writing activity. So recommending to sell on Oro Pharma with a stop loss of 460. And here we have a trading target to us 420 on the lower side.
Thank you very much for joining in. Need to slip into a very short break. When we return, we'll have the pre-opening rates and we'll also be joined by Sultan Beg of Nava Limited to talk about the company's arbitration relief that it's received. Stay tuned.